unicorns with an equal number waiting to join this club. However, as funding slows down and tailwinds become headwinds, how should startups, unicorns and soonicorns manage expectations? My colleague Shruti Mishra caught up with Ritesh Agarwal, the founder of Oyo Rooms, Kanwaljit Singh, founder and managing partner at Fireside Ventures, and Sanjeev Bikhchandani, the founder of InfoEdge, at the Hero Mind Summit to discuss sustaining entrepreneurship during these volatile times. Here's a slice of that conversation. Listen in.
We're all talking about the funding winter. It has slowed down. VCs, angel investors, private equity players have all shifted their focus from, beyond valuations to generating strong cash flows, really strong fundamentals. I want to know what conversations you're having with your portfolio companies right now. Has anything changed?
Conversations we have and we are having have never changed, because we have always said the same thing. For a while, it looked like we were saying the wrong thing. But now it looks like we were always saying the right thing. And we've always said, when every round, we would say, assume this is your last round, market may correct. If you don't get the next round, what's your plan B? Can you get to profit? And we have always maintained that the customer's money is better than the investor's money. Because if you're getting the customer's money and you're getting it at a price that's higher than your cost, chances are you have a viable business so long as you can get enough customers. Right? And if you're getting the customer's money, then the investor's money will almost certainly follow, should you need it and want it. Right? Because investors love to invest behind businesses that are getting customers. Right? On the other hand, if you get the investor's money first, it is not necessary that the customer's money will follow. Because the customer is very discerning. The customer will only buy you a second time if it worked for him the first time. Right? Whereas getting the investor's money is often about impressing two young MBAs across the table with your PowerPoint. And, if you're getting investor's money, it may just be a PowerPoint working, but if you're getting the customer's money, your product and your business model is working. Yeah? So yes. That's what we always said, and we maintain that.
And you've always been a strong believer in the power of the balance sheet. Kanwal, coming back to something that you mentioned about building lasting businesses, clearly there is immense potential. We've got interesting ideas. Now the ecosystem is favorable. We've got so many VCs, which we didn't have a decade back, perhaps. But what's holding back? We're not quite there.
To me, it is going back to fundamentals. If you can get your foundations right, if you can get the basics right, and that basics honestly are not rocket science. The other thing which I personally feel, and I mentioned to you before this panel that I have a contrarian view, I personally genuinely believe that this whole race to unicorn is a complete waste of time.
Yeah, and now decacorn also, we've got decacorn also.
Any corn. I think if you can get today if you see the sustained companies which have been around for 15, 20 years, I mean, take Naukri.com itself, but I'm saying look at the companies like Marico, look at the companies like Wipro. I mean, they have built tremendous value, which has been ahead of any benchmark you would take in the industry. But they got their basics right, they got the foundations in place. So why does that not apply to the venture investing world? And honestly, one of the, again, contrarian view is you raise so much money in the race for becoming a unicorn that it dilutes the entire cap table, including the founders, to a level when the only option left for you is to continue to chase growth and valuation again and again and again. Because I have seen cases where, let's take one of our companies, Mamaearth.
Yeah.
It's a unicorn. So we're proud of the fact it's a unicorn, but the founders own over 30%. So it didn't matter whether it was a unicorn or not. We have created wealth for the founder and for the investors.
Yes.
So to me, if you can take away that label of a unicorn, there are hundreds and thousands of companies which can be successfully built with limited capital, doing the basics right, and actually change the way investing is considered in the country, rather than saying, I need that one unicorn to be a successful fund. I don't even think that is required.
Sanjeev, your thoughts on what Kanwal just said, and what is that magic pill that soonicorns need? I know he said, don't believe in soonicorns, unicorns, decacorn, whatever, but what is that magic pill that needs to be there that perhaps startups need to understand and take?
paisa banao, paisa kamao. Okay? Now, look, you need good unit economics. You need to have a clear path to profit or be profitable. So, and you need to be capital efficient. I think what happened in the last decade since the global financial crisis in 2008-9, when there was so much liquidity, post-COVID again, there was so much liquidity, that valuation just shot up. So the number of unicorns we have would have been half if this liquidity did not exist, maybe 1/3. Right? This is all liquidity driven. What you need is to actually have customers, revenue, margin, profit, collection, cash flow, right? All the things that you used to focus on till money was abundant.
So like he said, paisa banao, paisa badao. Ritesh, talk to us about your laser focus on profitability, sharp unit economics at Oyo and in general.
Specifically for Oyo, look, I think when COVID hit us, that was sort of a unique transformation opportunity, right? Because in one way it could be seen as a problem, on the other side it is an opportunity.
Yes.
So we try to, of course, as entrepreneurs, use that as an opportunity by doing three things. By focusing on cash, making sure that every dollar of cash is looked upon, not just in terms of everyday operation as well as in terms of forward capital allocations. Second is cost, which is making sure that the break-even threshold of what revenue should we be break-even in, that was changed dramatically. And third is evolution. We focused in core markets of India and Southeast Asia. We said we'll go deep rather than going wide and so on. Our FY21 numbers are public, in which you will see that our EBITDA has improved by 10 points. Our contribution margin has gone from 5 to 18% and so on. But, I'm hopeful that very soon we will update results for this year's first quarter and we'll get the benefit of big travel growth that is coming out in the market.
So let's talk about IPOs and going public, which has been a large part of the startup ecosystem. Sanjeev, this is for you. While many lined up for a listing and for an IPO in 2022, the big one we've seen is delivery. And there's been a lot of downsizing of valuations. There's been a lot of postponement of IPO plans. For instance, we've seen PharmEasy. What do you make of this reluctance of tech startups to kind of, not go public? And when can we see this cloud lifting? And what are the other options available?
So for the ones that went public, which are trading below their listing price, their IPO offer price, I think you will have to, fundamentally improve operating performance quarter on quarter to be able to get back some of those valuations, or the market has to come back, or both. Right? But we are seeing, at least in Zomato and even in Policy Bazaar, performance improve every quarter, and it was as per plan. Right? I cannot comment on the others because I don't know them that well. But fundamentally, I think the Indian market was willing to accept loss-making companies going public with some enthusiasm, maybe till a year ago. And since then, when the market corrected, the tech market corrected in the US and following that in India, that enthusiasm has waned a bit. And therefore, you may or may not get the same kind of valuations that those companies got. And with lower valuations, if you've taken private rounds that are higher than that valuation, it's a little tough to go public. So some companies are therefore in a bit of a quandary.
Okay. Kamal, how do companies that are scaling up rapidly today, or perhaps unicorns, how do they need to differently prepare for a listing today?
Simple answer is get your house in order. There is no rocket science in defining what are the fundamentals of what you are doing, which will attract an investor, especially a retail investor in the market, because we forget that, these are all very good businesses.
Ritesh, I can't help but ask you about the Oyo IPO plan. You kind of hinted at it. I just wanted to know, will Oyo have a blockbuster Diwali?
So I think I knew this question was coming, but not to this specificity. Look,
I just said we wish you a very happy Diwali.
Yes, yes. No, look, I think first off, I think, clearly, Oyo has, we've waited it out to go public. And I think the reason for that is no different from what we just discussed about currently listed companies. It is, maturity of operating performance to show it consistently over a period of time. In short, the update from our side for a public offering is that we reached out to the regulator to allow us 2 quarters or the H1 financials to be updated for this fiscal, which is until September. And our hope will be to deliver great performance that everybody likes, and hopefully at some point of time go public after that.
Okay, and
So I will answer
Yes.
that. I will answer the question you asked him. I've been talking to him on and off, and without revealing anything confidential, I'm pretty hopeful that Oyo will have a very good next Diwali. Diwali aayegi agle saal.
Meanwhile, Pepperfry is planning to file its IPO papers by the end of 2022, but sources tell CNBC-TV18. But in an exclusive interaction, Pepperfry's co-founder and CEO Ashish Shah said that the company is planning to raise $250 to $300 million through its IPO, but did not reveal any timeline. This comes as the furniture marketplace reported a wider net loss of 194 crore rupees for FY22. My colleague Aishwarya Anand finds out how Pepperfry is rebasing its business in the post-pandemic era and ahead of its IPO. Take a look.
Furniture marketplace Pepperfry is expanding its offline footprint both in large cities and small towns in an attempt to stay closer to its consumers as it gears for the public market. Wanting to stay asset-light, the startup has opened at least 20 company-owned, company-operated studios with an investment of $5 million in the last 4 months. The firm is now aiming to transform from a high street business to a neighborhood store.
We are now 195 stores in close to 95 plus cities already. Over the last 1 year itself, we have opened around close to 100 stores. Omnichannel will continue to remain one of the important strategies for Pepperfry going ahead. From expansion standpoint, we are looking at tier 2 and tier 3 towns in a big way. To give you some idea, the last 100 stores that I'm talking about, 12 of them were opened in Northeast. You will also see us opening, our second or third stores in tier 1 towns like Indore. Indore, my third store is coming up. Patna, my fourth store is coming up. Jammu, we are opening our second store. Coimbatore, we are opening our third store. So therefore, there is a lot of interest coming in from these towns, and therefore our expansion is, heading towards tier 1, tier 2, tier 3 towns. The reason being, there are no strong national players who are present in these small towns.
The e-commerce furniture and home goods company is currently offering customers a diverse selection of over 120,000 SKUs. Pepperfry also recently acquired interior designing startup Brandmaker to carry out commercial interior designing projects.
We have close to 5 million visits that happen on the platform every month. From get-go, from the day we started our business, we have always talked about great variety and great price as our single largest proposition, right? And we continue to execute to that. I have 18,000 different types of furniture pieces to choose from. They are available in various colors thereon. We would like to have share in every area where furniture is being sold today, right? And therefore, the acquiring of Brandmaker is to actually get into the fit out space. We want to do furniture for restaurants, cafeterias, small hotels, offices, etc. Selling furniture to Government of India through various departments. We would look at exporting furniture to many more countries. So that these are other areas that we are interested in, and we will get into really soon.
Pepperfry has also been piloting its 24-hour delivery service called Pepcart. The in-house delivery platform provides first and last mile logistics services to its consumers. Now, to enable this quick delivery, the startup has set up manufacturing units across Mumbai, Delhi and Bengaluru, servicing over 10,000 pin codes. Pepperfry's financial performance has not been impressive in FY 2022, as its losses widened by 83% with an average growth in operating income. It primarily earns revenue from the commission on the goods and articles sold through its marketplace and offline stores. This income grew 14% to rupees 224.5 crore in FY 2022.
In terms of my online and offline business mix, with the expansion of Omnichannel, significant expansion over the last 1 year, Omnichannel is now around 45 to 48% of my overall business. We believe that every store that we opened pre-April is now going to show big results in the month of October, November, December, and therefore, fingers crossed, looking at a big season months going ahead for us.
Despite the losses, the company is all set to hit the public market soon and is planning to file its DRHP with SEBI by the end of 2022.
I am in a silent period right now, so not talking about IPO and timelines, etc. But we are looking to raise around $250 to $300 million, through the IPO. You will see us launching many new features for our customers in the times to come. features that would allow them to sit at their home and make large ticket size purchases without actually even going to a store.
The pandemic has given an impetus to the online furniture market. Earlier, the space was dominated by horizontal players such as Amazon and Flipkart, but now the focus has shifted to vertical platforms such as Pepperfry, Urban Ladder, among others. With the rise in digitization, online channel sales and urbanization in metros and tier 1 cities, India's online furniture and home market is projected to touch $40 billion in size in the next 5 years as per a Redseer report. The online furniture category will also witness a 3x growth in shoppers in the next 5 years, along with a 1.8x growth in annual spending per shopper. It is also estimated that the furniture market will largely be governed by the marketplace model. With camera person Saroj Singh, Aishwarya Anand for CNBC-TV18.
On that note, it is time for us to head into a short break. But coming up next, the festive season is right around the corner and e-commerce majors are all readying themselves for it. We check in with Meesho on their plans for the festive season. A special report on the other side. Stay tuned. The festive season is almost here and e-commerce majors are all set to make the most of it with the launch of their online festive sales. Meesho's prime focus this year is attracting new users who are new to e-commerce. My colleague Ritu Singh checked in with Meesho's Chief Experience Officer for Supply Growth, Lakshmi Narayan Swaminathan, who said that the festive season is a good time to acquire new users. He also expects the annual festive sale to be much bigger this year. Take a look.
E-commerce firms are gearing up for what is easily the biggest event of the year for them, and that is their annual festive season sales. Revenge shopping is the name of the game this time around, but gone are the days when it was a two-horse race. SoftBank-backed Meesho is also joining the battle along with the likes of Flipkart and Amazon with its very own mega blockbuster sale. I'm here at the Meesho headquarters in Bengaluru to find out how the company is preparing for these. Thanks again for speaking to us. Let me briefly start by asking you, this is your second time having this huge online festive season sale. What are the expectations this time around in terms of number of users that will be onboarded, new and existing, the kind of revenue it may generate, the kind of sales you may see?
Sure. So from a sale perspective, right, if you look at it from our overall mission, and this is only the second time that we are doing such a big sale during the festive period, it's a lot more focused on getting closer to our overall mission where we are trying to serve the underserved, new to e-commerce sort of users. So if you were to go by some past sort of numbers, just over the last 12 months, we've grown about 2.5 times in terms of our monthly transacting users, 3 times in terms of seller base, 4 times in terms of overall selection. So some of those, just the baseline increase from last year is going to really act as a springboard, but not in terms of specific say numbers, because this is a sale where we are still trying to go as much as possible in terms of maximizing on.
But the idea is very much to bring on board new customers that haven't been on Meesho before.
Yeah.
Do you think this festive season sale is going to help bridge some of the gap when it comes to competition from your peers, for instance?
No, absolutely. So in fact, we don't take a competition sort of lens to some of this, because if you see, we've been challengers starting up when there were already established players in the market, and we've been able to really make a mark. Yeah. And if you look at the overall sort of user side of the market also, there are possibly about only 250-300 million people who are actually transacting online. Whereas, say, if you were to take any of the social media sort of apps like say WhatsApp or anything else, there are closer to, or smartphone users, there are 700-800 million. So there is a huge ground still to be covered. We believe that the festive period is a great time to get a lot more users, and that's what all our focus has been, to get the quality products at the lowest prices.
Got it.
We can
so,
get that.
you know, what's the kind of sales you did last year when you hosted this for the first time? And what sort of an increase are you expecting this year around, especially that it's coming after the pandemic lull?
So, last year itself also, if you were to look at it, it was through the pandemic that we actually got this through, so it was not so much that. Last year, if you were to look at it, overall what we did through the entire month was closer to about 80 million orders that we did last year during the entire festive period.
And revenue generation?
Revenue is not something that we look at. We look at a lot more from an order perspective. But this time we expect that it will be significantly more, but not in terms of specific targets. Like I said, it's a lot more to the extent of user acquisitions and say seller acquisitions and creating that kind of success. It's not so much from only dependent on sale or pushing that through is not the objective.
What sets apart Meesho from the others? You said, last time when you hosted the sale, 80% of the buyers were actually from Tier 2, from the Bharat cities of India. Is that going to continue to be the focus area for Meesho? Are you not going to look at metros as much?
Absolutely, Ritu. Our focus is very crystal clear that what we are trying to do is on the value conscious sort of segment. If you were to think of any particular product, if you want a quality product, cheapest price that is possible or the lowest price that is possible, you will get it on Meesho. So to that extent, if you were to look at it, say 70 million overall products that we have on the platform, about close to 70% of them you will only find them on Meesho, and whatever matches with others also, you will find them at least 15 to 20% lower value on Meesho compared to any other platform. So if you were to think of all of those, our focus is going to be razor sharp on continuing to build on that entire story and get the new to e-commerce sort of users on board. That's our overall objective, and we are only going to get deeper. It might be more than 80% as well.
Are you worried at all if inflation could play spoil sport? That has been a big concern when it comes to discretionary spend, especially with the kind of rates that we've seen over the last year with inflation.
Sure. So from an inflation perspective, there is obviously in the macro environment, some of those concerns do obviously remain from a demand perspective. But what you will also see is that when there are inflationary pressures that are a lot more, what customers naturally gravitate towards more is on value, and that's only going to play to our strengths in terms of, say, Meesho compared to any other platform. So that entire part is going to be as much as a market level trend on demand, whatever it may be, but within that to garner share, I think it's going to be a huge tailwind for us.
All right, Lakshmi Narayan, thank you very much for that. It's been a pleasure chatting with you.
Thanks a lot.
Estimates suggest that online festive sales could grow by as much as 28% over the previous year, and this should come as music to the ears of e-commerce players like Meesho, who are hoping inflation does not play spoil sport. With camera person Manjunath, this is Ritu Singh.
It is Friday and it's time to take stock of all the new deals that took place in the startup world. This week, as per Venture Intelligence, saw that the Indian startup ecosystem witnessed a total of 22 deals valued at over $200 million. A total of 905 deals have taken place this year so far, valued at over $20.5 billion. Let's take a look at some of the notable deals that we saw this week. InsurTech startup Zopper bagged $75 million from Creages, ICICI Venture, Bessemer Ventures and Bloom Ventures. D2C firm Join Ventures raised over $23 million from Motilal Oswal, DSG Consumer Partners and others. That's not all. EdTech platform Bhanzu got $15 million from the likes of 8 Roads Ventures, B Capital and Lightspeed Ventures. Deep Rooted raised $12.5 million from Ivy Cap Ventures, Axel India and others. And video tech startup Rephrase.ai bagged over $10 million from Red Ventures, Silver Lake, 8VC and others. And with that, it is a wrap on this edition of Startup Street. More news and updates coming up on the other side. Stay tuned.